Dealerships across America are in absolute crisis mode, and this isn't clickbait. This is the biggest meltdown the retail car market has seen in more than a decade. Prices are falling harder than anyone expected. Inventory is stacking up like unsold TVs in a bankrupt electronics store. And even with discounts, rebates, and record-breaking incentives, buyers are still staying home. Dealers are quietly admitting what automakers refuse to say out loud. The entire market has flipped from scarcity to desperation, and the old tricks aren't working anymore. Walk onto any lot right now and you'll see it instantly. Rows of brand new trucks and SUVs sitting untouched for months. These aren't slow sellers. These are the exact vehicles that once sold themselves the moment they arrived. But the buyers who used to fight over them are now walking away completely. Interest rates, insurance costs, and economic uncertainty have collided at the same time, creating a perfect storm that even massive price drops can't fix. Dealers are slashing thousands off the sticker, offering long-term financing, and begging manufacturers to stop sending shipment after shipment, but the pipelines keep flooding anyway. And behind the scenes, managers are panicking. Some dealerships are holding secret fire sale events they don't even advertise publicly, hoping to quietly clear out aging stock before the end of quarter reports expose just how bad the situation really is. You've got salespeople who once pulled in six figures now barely making a fraction of that because foot traffic has collapsed. They're calling past customers, texting old leads, offering deals that would have been unthinkable 2 years ago, and still getting ghosted. What's even more shocking is that used car prices, which were supposed to stabilize, are now in free fall again. Vehicles that sold for insane premiums during the pandemic bubble are suddenly worth thousands less, leaving people upside down on their loans and terrified of trading in. Dealers can't touch trade-ins unless they steal them at rock bottom prices because wholesale auctions are overflowing with repossessions and lease returns that no one wants. It's a chain reaction, and every link in the system is under pressure. Automakers are stuck too. After years of inflated pricing, low inventory, and aggressive production targets, they miscalculated demand so badly that factories are still pumping out cars for a customer base that simply isn't there anymore. Some OEMs are quietly offering dealers behind the curtain cash to move metal, while others are hoping new facelifts or EV incentives will magically revive demand. But dealers aren't buying the optimism, literally. They're telling manufacturers, stop sending us cars we can't sell. And here's the wild part. Even brands with strong reputations, Toyota, Honda, Ford, Subaru, are starting to see cracks. Not because the vehicles are bad, but because consumers are exhausted. The average monthly payment is now higher than many people's rent used to be just 5 years ago. Insurance premiums are exploding nationwide. Maintenance and parts are more expensive than ever. The cost of owning a car has become a financial burden that many families can no longer justify, and no discount on the lot can change that overnight. Meanwhile, EVs are stacking up faster than anything else. Dealers can't move them, automakers can't slow production fast enough, and a massive wave of unsold electric inventory is clogging storage lots across the country. Incentives on some models have ballooned to 5 figures, yet shoppers still hesitate because of charging infrastructure, depreciation fears, cold weather range problems, and the simple fact that the early adopter hype has burned out. The EV slowdown has become so severe that some dealers are refusing new allocations altogether, and this pressure cooker is exposing a deeper issue that's been simmering for years. The dealership model itself is breaking. Buyers don't want the games, the markups, the paperwork, or the haggling. They don't want to spend 4 hours in a chair waiting for someone to talk to the manager. They're fed up with add-ons, fees, and predatory loans. The pandemic didn't just change the market, it changed buyer psychology. Consumers tasted online first car buying, transparent pricing, no pressure shopping, and they don't want to go back. Dealers see this shift happening in real time, and many of them are terrified because they know they can't compete with the convenience and transparency customers now expect. Some are scrambling to overhaul their processes, trying to make buying a car feel more like ordering something online, while others are doubling down on old school tactics and driving customers away even faster. The split inside the industry is widening, with forward-thinking dealerships adapting and survivors clinging to outdated methods that are now pushing them toward collapse. But even the most modern dealerships can't outrun the brutal math. Floor plan interest, the cost dealers pay to keep cars on the lot, has exploded. The longer a vehicle sits unsold, the more money it bleeds. And right now, cars aren't sitting for 30 days. They're sitting for 120, 180, sometimes more. Dealers are losing thousands just by holding inventory, and those losses stack up month after month. Some stores have already started slashing staff, cutting hours, delaying renovations, and putting expansion plans on ice. If this trend continues, you're going to see a wave of dealership closures across the country. And let's talk about those record incentives, because behind the flashy ads is a far more desperate truth. Incentives today aren't about attracting buyers, they're about preventing catastrophe. Automakers know that if dealers get stuck with too much inventory, everything breaks. Production slows, profits disappear, investors panic, layoffs begin. So they're throwing cash at the problem, offering low APRs, loyalty bonuses, conquest bonuses, lease cash, dealer cash, regional cash, stackable discounts that didn't exist even in the darkest days of 2008. But the more incentives rise, the more obvious it becomes that demand is collapsing. This crisis isn't just about money, it's about confidence. Buyers no longer trust the market. They believe prices will fall further, and they're probably right. They believe better deals are coming, and they are. People who rushed into overpriced vehicles during the pandemic are warning their friends not to make the same mistake. Social media is flooded with advice telling buyers to wait, hold off, push down payments higher, or avoid buying altogether. And when millions of people decide to sit on the sidelines at the same time, the industry freezes. Meanwhile, banks are tightening up. Lenders who once approved borderline applications are now declining them outright. They're demanding larger down payments, higher credit scores, shorter loan terms, and stricter income verification. This hits the exact buyers who used to drive volume sales. People upgrading every few years. People financing longer terms, people buying used instead of new. With approvals dropping, dealers aren't just losing customers, they're losing entire market segments overnight. And as the financial pressure builds, manufacturers are starting to look for someone to blame. Some are pointing fingers at dealers, some are blaming the economy, some are blaming interest rates, some are blaming EV hesitancy. But the truth is deeper. The entire auto industry became addicted to high margins, low inventory, and artificially inflated prices during the pandemic. They assumed the boom would last forever, and when reality hit, they weren't prepared for the crash. Now the whole structure is wobbling, and no one wants to admit how fragile it's become. Customers can feel that instability. They can sense the uncertainty in every ad, every price drop, every desperate promotional event. And that's pushing them even further away, because no one wants to buy a major asset in a market that feels like it's cracking open. People would rather wait out the storm than walk onto a lot where desperation is par, and what's really sending shockwaves through the industry is the rise of the wait and pounce buyer. These are shoppers who are ready to buy, have the cash, have the credit, and have the desire. But they're sitting back like predators watching the market slowly weaken. They know the longer they wait, the better the deal gets. They know dealers are getting squeezed. They know automakers are getting desperate. And they're not rushing into anything because every single economic indicator is pointing in one direction: deeper discounts ahead. Dealers can feel these customers lurking, browsing quietly online, watching inventories swell, waiting for the price to break. It's psychological pressure, and it's crushing. This shift in buyer behavior is something the industry was never ready for. For decades, dealers relied on urgency. Last one on the lot, prices go up next month. We can't hold this deal. But those tactics don't work when the internet shows hundreds of identical cars sitting unsold within a 200-mile radius. There's no urgency anymore, there's no scarcity, there's no fear of missing out. If anything, there's fear of buying too soon, and that fear has become the most powerful force in the entire market. Meanwhile, automakers are quietly starting to make brutal decisions behind closed doors, slowing factory lines, reducing shifts, canceling model variants, delaying launches, reevaluating EV programs. Some brands are already having internal debates about whether they can sustain current pricing structures, or whether they need to introduce stripped down, lower cost models just to bring back budget conscious buyers. The industry went premium heavy, assuming people would always pay more, and now that strategy is collapsing in real time. And while all of this is happening, a wave of lease returns and repossessions is hitting the market like a tidal surge. Vehicles that were wildly overpriced faced during the pandemic are suddenly coming back, and dealers don't know what to do with them. The auction lots are so full that units are being stored in overflow fields, parking garages, and temporary rented land. Prices at auction are dropping faster than retail prices, meaning dealers who stocked up earlier this year are now sitting on losses they can't escape. Some are even dumping cars at a loss just to get out from under the floor plan interest strangling them each month. The scary part is that customers see all of this too. They're not blind. They're watching TikToks of dealers complaining about inventory. They're seeing CarMax and Carvana slash prices week after week. They're hearing about automakers offering huge rebates. They're reading articles about auction crashes and dealership layoffs. For the first time in decades, buyers feel like the power is in their hands, and that's something the auto industry isn't used to. And then there's the elephant in the room, trust. Consumers simply don't trust dealership pricing anymore. After years of pandemic markups, fake scarcity, bogus fees, and inflated MSRPs, people feel burned. They feel taken advantage of. They feel manipulated. And now that prices are falling, those same buyers are watching the industry try to pivot back to friendly and customer first, and they're not buying it. The credibility gap is enormous, and it's one of the main reasons deals aren't closing. But here's where things get even more dangerous for the industry. Younger buyers, Gen Z and younger millennials, are starting to opt out of car ownership entirely, not because they don't want cars, but because the cost makes no sense. They're using rideshare, public transit, biking, scooters, subscription services, or simply delaying driving altogether. And when an entire generation steps back from buying, the long-term consequences are catastrophic, actively dripping from the windshields. Dealers can already see the generational shift happening in their showrooms. Younger shoppers walk in, take one look at the pricing sheets, and walk right back out. They're not playing the negotiation game, they're not wasting time with sales pitches, and they're certainly not signing 84-month loans at interest rates that look like credit card APRs. They'd rather wait, share a car with family, or buy something cheap and used than jump into a financial commitment that feels like a trap. And that mindset is rewriting the future of the auto market in real time. At the same time, insurance costs are becoming the silent killer of new car sales. Forget the sticker price. Insurance premiums have skyrocketed so aggressively in the past 2 years that buyers who thought they could afford a car suddenly can't. Dealers are reporting customers who get approved for the loan, love the vehicle, agree on the price, and then walk away because the insurance quote hits them like a punch to the stomach. $1,000 monthly premiums aren't rare anymore, especially for new drivers or high theft models. When insurance costs more than the car payment, the deal is dead on arrival, and manufacturers know this is hurting them, but they have no control over it. It's a perfect example of how external factors are crushing demand. The cost of repairs, the cost of replacement parts, the price of advanced sensors and ADAS systems. All of it has pushed insurers to hike premiums to record highs. And every time those premiums rise, another chunk of potential buyers disappears from the market entirely. It's a silent crisis that's accelerating the sales collapse. Meanwhile, the rental car companies, normally a safety valve for excess inventory, are pulling back too. After overbuying during the post-pandemic travel boom, rental fleets aren't rushing to restock anymore. Some are downsizing, some are delaying orders, and some are pivoting to used vehicles to cut costs. That means one of the industry's biggest bulk customers is suddenly buying fewer cars, creating yet another bottleneck of unsold inventory flowing straight back to dealerships. And as all of this unfolds, the tension between manufacturers and dealers is beginning to reach a breaking point. Dealers are demanding fewer shipments, better incentives, and more flexibility, while automakers are insisting dealers accept allocations to keep production running. Some brands are even threatening penalties if dealers refuse inventory. It's becoming a tug of war between two sides that desperately need each other, but are trapped in completely different realities. Automakers want volume. Dealers want survival. Those goals no longer align, and the rift is widening. Underneath the chaos, the used market is creating its own set of problems. Depreciation is accelerating at a pace the industry hasn't seen in years. Cars that held value shockingly well during the pandemic are now losing thousands in weeks, not months. Buyers who finance cars at peak pricing are discovering they're upside down by $5,000, $10,000, sometimes $15,000. That traps them in their current loans and removes them from the buying pool entirely. The pent-up demand analysts kept promising simply isn't materializing because the people who would normally trade in can't escape their loans without taking massive losses. And then there's the supply chain side. For years, the narrative was that shortages were driving prices up, but now, the opposite. Supply chains have normalized, parts availability is up, production is consistent, the flow of vehicles is smooth, and the industry is learning the hard way that overabundance is just as dangerous as scarcity, maybe even more. When cars were scarce, consumers paid anything. Now that cars are everywhere, consumers are paying nothing. And here's the kicker, even when dealerships slash prices to levels that would have seemed impossible a year ago, people still aren't buying. It's not a small group of holdouts, it's mass behavior. Analysts are calling it a buyer strike, and it's spreading across every segment: sedans, SUVs, trucks, and EVs alike. Even with 0% financing, cashback incentives, loyalty bonuses, and trade-in sweeteners stacked on top of each other, the phones aren't ringing like they used to. Foot traffic remains shockingly low. People are sitting back, waiting for the next wave of markdowns, and that waiting game is killing profitability. Dealers are bleeding money on every transaction that actually closes, and the ones that don't, those cars just sit on the lot, accumulating interest, depreciation, and storage costs. Some dealerships are literally selling vehicles below invoice just to generate cash flow, but even that desperate tactic isn't enough to clear the inventory. The numbers don't lie, margins are razor thin, losses are mounting, and the more inventory they have, the deeper the hole becomes. Then there's the psychological toll on dealership employees. Salespeople, finance managers, and lot attendants who once thrived in a high-volume, high-pressure environment are now demoralized. Commission checks have shrunk, stress has skyrocketed, and the optimism that kept teams motivated is evaporating. Some top performers are leaving the industry entirely, seeing no point in struggling for deals that might never close. Turnover is increasing at record levels, and with fewer experienced staff on the floor, even the customers who do walk in may not get the guidance or confidence to buy. Meanwhile, automakers are trying everything to stimulate demand, and some of their tactics are downright radical. From extreme lease deals to EV subsidies to buyback programs, they're throwing everything at the problem, hoping to ignite even a small spark of buying frenzy. But there's a growing realization that incentives alone won't fix the underlying issue. Buyers don't trust the market, and they don't trust the value of the vehicles they're being asked to pay for. Trust, once broken, is extremely hard to rebuild, and the industry is learning that lesson the hard way. And let's not forget the regional disparities that are amplifying the crisis. Coastal markets may have slightly higher demand, but rural and suburban lots are overflowing with unsold units. Some dealerships in the Midwest and South are facing months-long stagnation with no relief in sight. Even luxury and premium brands aren't immune. High-end vehicles, which used to be recession-resistant, are now sitting for weeks or months because buyers are holding cash and rethinking big purchases in the current economic climate. At the same time, financing structures that used to drive sales are failing spectacularly. Long-term loans, balloon payments, and creative leasing deals are losing appeal. Buyers are realizing that taking on massive monthly obligations for a depreciating asset isn't smart, especially when they can wait for the inevitable further price drops. Dealers are caught between needing to move cars and not wanting to push customers into deals that leave them upside down immediately. But the longer they wait, the worse the financial picture becomes. And while all of this unfolds, the online car market is adding another layer of disruption. Platforms like Carvana, Vroom, and CarMax have transformed the way people shop, giving buyers full transparency, instant quotes, and home delivery. Traditional dealerships can't compete with that speed and convenience, and it's pulling even more potential customers off the lots. What used to be a negotiation in person is now a click-and-wait process online, and the longer dealerships resist modernizing, the further behind they fall. The digital-first approach is changing expectations permanently, and dealers who fail to adapt are watching sales evaporate in real time. Even worse, some dealerships are caught in a vicious cycle of desperation pricing. They slash prices to try and lure buyers, only to see competitors match or beat them within days. That triggers another round of price cuts across the region, eroding margins even further. The result? Everyone loses. The illusion of a competitive marketplace is actually pushing the industry toward a race to the bottom, and nobody knows when or if it will stabilize. And it's not just new cars. Used cars, which were supposed to be a buffer for dealers, are now a problem too. Values are collapsing, repossessions are surging, and auction floors are flooded. Dealers that once relied on trade-ins to subsidize new vehicle sales now face the opposite. They're taking massive losses on incoming trades just to move the inventory they already have. Some stores are holding events to dump used cars below cost, but with buyer confidence shattered, even fire sale prices aren't enough to generate volume. Then there's the broader economic context driving this behavior. Inflation, rising interest rates, energy costs, and a looming recession are keeping buyers on edge. Consumers are weighing every purchase against uncertainty, and a car, historically the ultimate high-ticket purchase, is suddenly the last thing on their mind. Even those who can afford it are hesitant because they don't know what next year will bring. It's a perfect storm of fear, skepticism, and financial caution, and dealerships are stuck in the eye of it. At the same time, automakers are feeling the heat from investors. Wall Street has become impatient, expecting growth, stability, and healthy margins. When quarterly earnings reports reveal slowing sales and rising incentives, stock prices wobble.